Namaskar friends, welcome to the channel JIB and CIB Made Simple. If you are looking for IIBF CTP memory based question which appear in the examination on 26 July 2025, then you are at the right place because we are going to discuss all the important MCQs and if I tell you the weightage of numerical and theoretical portion, please understand that numerical accounts for almost 40% of the syllabus while theoretical question accounts for near about 60% of the syllabus. So you can see the importance of numerical. That's why we are beginning with some numerical question. I will request you to have pen, paper and calculator with you. Try to solve the question on your own and then listen to the explanation. This way you can get the maximum efficiency of this particular video. So let's get started. The first question is, a bank has a required CRR of 600 crore, right? And they have mentioned that the required CRR they have mentioned of how much 600 crore, 90% minimum. But on a particular date, it maintained only 540 crore. The prevailing bank rate they have given 7%. Now, if the RBI penalty for non-compliance is how much penalty is there? Bank rate plus 3% per annum. That is the penalty that RBI charges. So the question is, what is the penalty amount for a day's default on the shortfall? That's the question. Very good question it is. Let me show you the option. Option A says that interest at 7% for a day on 60 crore. Option B says that interest at 10% for a day on 600 crore. Option C says that interest at 10% for a day on 60 crore. And option D says that interest at 7% for a day on 550 crore. So let me show you the entire question in a single slide. So this is the question. So friends, in the question, as you can see, required CRR have given, right? First of all, what we will interested in finding the shortfall. Right? What is the shortfall in CRR? Very simple. You see how much is the required minus how much is the maintained. Right? So this difference will be the shortfall. As you can see here, required is 600 crore. Right? You can see clearly that required is 600 crore and they have maintained only 540 crore. How much is the shortfall? Obviously there is a shortfall. So 600 minus 540. So this will give you 60 crore. So that is the shortfall, right? Think that you were supposed to keep 600 crore but had only 540 crore, so you are short by 60 crore, isn't it? Okay. Now they are asking to calculate the penalty rate. They have mentioned clearly that penalty is bank rate plus 3% per annum, and bank rate they have also given 7%. I think this is the simplest question possible. See, don't get frightened by seeing the lengthy question. No. Everything is given in the question. Just go through each and everything minutely. So what is the penalty rate? What would be the penalty rate? It is very simple. You first write the base rate, right? To find the penalty rate, what you have to do? First of all, what you do, right? You write the base rate here. Okay. So it is base rate plus how much? 3% extra. Right? Clearly they have written base rate plus 3%. So 7% base rate plus 3%, which is extra. So total become penalty rate become 10%. So that is your penalty rate 10% per annum. Right, this is the penalty rate per annum. Now one concept is that this particular penalty apply only on the shortfall and the period for the default. Please understand. Till when this penalty will apply? See, two things are very important. First of all, it will apply on the shortfall only. And second thing is that it will apply for a period of default. Can you tell me what is the period of default? Can you please tell me what is the period of default? It is clearly written for a day default. So means what? Single day, right? So penalty will apply on the shortfall, and that too the period of default. Here the period of default they have mentioned is 1 day. So can you calculate what is the 1 day penalty? Very simple. The rate they have given you 10% they have given, isn't it? 10% is the annual rate and they have to calculate the penalty for a single day. How to go about calculating the penalty for a single day? Very simple. Just apply the formula, right? Penalty is 10% of what? 10% of obviously the shortfall. Shortfall is how much? 60 crore. So just take 10% of 60 crore, and since this will give you the annual penalty, but you 10% of 60, right? So what would that be? What would be the 10% of 60? Right, very simple. It is nothing but 6. Okay, and since we have to calculate it over 1 day, so we'll multiply it over 1 upon 365. Okay, this is the unitary method, basic unitary method, which you can rely on, right? Now friends, now just apply the formula, right? So it will be how much? 6 crore divided by 365. So approximately if you get the value, it will be 1,64,384, or we can say 1.65 lakh, right? For that day. So if you look at the option that we have, so option number A says that interest C 7% for on 60 crore. What option number A is saying? See, this is the wrong rate, right? Why? Because penalty rate is bank rate plus 3%, so 7% is wrong. Option number B say interest at 10% for a day on 600 crore. So again it is wrong amount. Why? Because penalty is charged only on the shortfall, not on the entire amount, right? That is the point. What about option C? Option C is yes, correct. Right. Option D is also wrong. Why? Because they're saying interest is 7%. Again, this is wrong. So friends, like imagine you promise to keep 600 rupees in the bank locker for safety, but you keep only rupees 540. Just I am giving you one example to understand it more clearly. Imagine that you promise to that you will keep 600 rupees in a locker, but you keep only 540 rupees. So the regulator, they charge a penalty like a late fee, and that fee is charged only when you missed it. Only what you missed, that is the 60 rupees, right? That penalty will be charged on 60 rupees only. So you don't pay the fee on the whole locker amount, rather you pay only on what you missed. So remember what we learned from this question. The key learning from this question is that let me write down the basic learning. Please note it down. That suppose if they ask you to calculate the penalty, right? Just remember the formula. Whatever is the bank rate, just let me erase it. Yes. So if they ask you to calculate the penalty, what you need to do? Just write the bank rate. Please note down the formula. Just write the bank rate plus 3%. So it will be mentioned in the question, right? And then multiply it by shortfall, which means how much shortfall it is in terms of amount, and multiply it by time, right? And one more thing is that how to find the shortfall. So to find the shortfall, the formula is very simple. You write the required and you subtract the maintain. Required minus maintain, that is the shortfall, right? And what is the time here? Time is the period of default, right? Time is the period of default. How to find the time? Very simple. Just divide days by 365. That will give you the time. I hope this is clear, crystal clear now. Now friends, let's see the next question. Again, this is a numerical based question. Please go through this question once more. So the question says that a zero coupon bond is there, right? It has a face value, they have given 2000 rupees. So first of all, zero coupon bond, face value they have given $2000, I think, not rupees, $2000. And it is maturing in 8 years. Fine. Now, one more point they have given that if the market required yield, so yield of market is 7.4% per annum and compounded semi-annually. This one is very important. Compounding is to be done semi-annually, right? Now friends, question is asking you what is the closest approximate price of this bond? Very good question, right? Please see the key terms which I mentioned here, right? Now options are, options, let me show you 1134.80, 1105.10, 11, these are the 4 options. So first of all, try to solve it on your own. Let me explain. So first of all, do you know the meaning of zero coupon bond? Do you know when I say zero coupon bond, what does it mean? Let me explain. So friends, zero coupon bond means here what? It will pay nothing. It will pay nothing till maturity and then pay the face value of $2000. How much is $2000 at the year end, right? At the year end, right? So see, let me show you the cash flow, how it will look like. So initially you have invested how much? $2000. So this is your investment. $2000 invested. First year 0, second year 0, third year 0, till 8th year you will get 0, and then till the 7th year, and the last year you will get this $2000, whatever you have invested, isn't it? Right, but they are offered at a discount. This will not exactly cost you $2000. It will cost you a little bit less. Fine. Now that is the point. That is about the zero coupon bond. Okay. So basically, it is not offered at $2000. They will offer you certain discount. You will buy this at certain discount, and this will be redeemed at the face value. Remember, zero coupon bond are bought at the discount value and redeemed at the face value. Right. Now we have to find the price. What the question is asking us to find? Calculate the closest approximate price of this bond. That is what question is asking you, right? So now, how to go about finding the price? Do you know the formula? See, the price is very simple. Let me show you the formula here. Let me show you the formula. See, basically what we need to do, we have to discount it. We have to discount the price. How to go about discounting it? Very simple. See, this is your cash inflow, $2000, and just you discount it to the today's date. How to go about discounting? Very simple. So we are trying to find the present value, which is nothing but future value, divided by 1 plus r whole to the power. I think you are familiar with this formula, right? Okay, friends. Now, first of all, we must understand one thing they have written is that, in the question they have mentioned clearly that it is to be compounded semi-annually, right? It is to be compounded semi-annually. So what is R? What is R will be, sometimes I or R. So the IR will be, capital R divided by 2. Isn't it? Because in a particular year there are 2 semi-annual, And what is the capital R they have given? Capital R they have given is 7.4. So it will be how much? 7.4 divided by 2. That would be 3.7%. Right. So this is our, R, small r, right? Interest rate. And what about N? Can you tell me what about N? See, capital, so this N will be capital N multiplied by 2. So what is N they have mentioned? 8 years, right? And 8 years. So 8 multiplied by 2. So you can simply think like this. In a particular year, there are two frequency, right? Two compounding frequency. So in 8 years, there will be 60 compounding frequency. I hope it is crystal clear right now. Isn't it? Now let's discount the future value of $2,000 to the present terms. So what will be the number would look like? Look at it here. So 2000 divided by 1.037 to the power 60. Isn't it? So this will, if you calculate it using the calculator, the closest option you will get 111.8.33, which is near about 111.8.33. Is it clear? Right. So that is how we find the closest approximate price of a bond. Right. So friends, remember, think of the bond like a promise. Someone promised to pay you $2,000 after 8 years. If the people require 7.4% return, you will pay less today for that promise, right? How much you are paying? You are just paying 11118.33. You are just paying that, right? So we calculated what that less amount is. Again, I am repeating. You can think of a bond like a promise, right? Someone promised to pay you $2,000. Suppose I promise to pay you $2,000 after 8 years, right? After 8 years, I promise that I will pay you $2,000. So, and how much return I require? I require is 7.4%, obviously, right? So obviously you will pay less today for that promise. The higher the required return, the lesser you pay now. Suppose instead of 7.4, it goes to 8%. So this rate is increasing, right? So what will happen? The bond price will decrease, isn't it? The higher the required return, the less you pay now. That is what. How do we calculate it? We calculated what that less amount is, and that less amount is 118.33. So remember, the formula that you need to remember is this formula, right? To compute the present value of a euro coupon bond. Please let me know if this concept is clear or not. Friends, if you are looking for study material for CTP examination, we have fully fledged coverage of study material in forms of PDF, videos, mock test, as well as such kind of previous year questions. You can WhatsApp me on this particular number to get detail related to the CTP examination. Many aspirants have cracked the paper using our content. You can also crack in the simplest way possible. Now friends, let's switch our focus to the next question that we have. This is the third question, right? I request you to please try to solve it on your own first and then see the explanation. This will help you to understand the concept. So the question is saying that there is a portfolio, right? And it is generating an annual return of 12%, right? Risk-free rate they have given 5.5%. Standard deviation of the portfolio return they have given 4.5%. You have been asked to calculate the Sharpe ratio. Exactly this question appeared in the examination. You have been asked to compute the Sharpe ratio, right? Very good question it is. So let me explain how to go about calculating the Sharpe ratio. First of all, you must understand what is the meaning of this term so-called Sharpe ratio. Let me explain it here. Let's understand the meaning of this term. You know it very well. It measures that how much extra return you earn for each unit of risk you take. Very, very important. Each unit of risk you are taking, how much extra return? Extra return is how much? Right. That is called the Sharpe ratio. Now let's plug in the number. Right. Now let's plug in the number. So friends, the formula of Sharpe ratio is very simple. Right. First of all, you write the portfolio return. Portfolio return minus risk-free rate divided by what? Standard deviation. Standard deviation. Now friends, let's plug in the formula, plug in the value that we have. So how much extra return you earn for each unit of risk that you take. Now in this case, as you can see, annual return they have given 12%, risk free they have given 5.5%. So it is very simple, right? Just plug in the formula 12 minus 5.5 divided by 4.5. So how much would that be? I think 12 minus 5.5 will give you how much? 6.5 divided by 4.5. That will be 13 by 9. It will be approximately 1.44. Isn't it? 1.44 is the correct answer. Yes, option B is the correct one. Yeah, this one is the correct one. 1.44. Right. So friends, you can think of it like this. Let me explain a way to think about it. Suppose that you invest in a portfolio. Right. It gives you extra 6.5% return. You can see now, risk-free rate is 5.5. What is the meaning of risk-free rate? suppose you invest in a government bond, and you know government bond has nothing to, it is the safest bond, that is there is no risk in there. So the government bond yield will be 5.5, and you are investing in a portfolio where return they are given is 12%. So how much extra return they are generating? Tell me. How much extra return they are generating? Obviously, nothing but 12 minus 5.5, which is equal to 6.5%. The 6.5% extra return they are generating, right, above the safe option. But yes, you took 4.5 unit of risk. What does the standard deviation indicate? A standard deviation is indicating that how much risk you are taking. Think about it. For 4.5 unit of risk you are taking, you are getting 6.5% return. Now the question is, for the 1 unit of risk you are taking, how much return it is generating? That's called the Sharpe ratio. This is the simplest way one can understand. Think about it like this. Unitary method. You know about unitary method? I think you know it very well. See, what I am telling you, that for 4.5 unit of risk that you are taking, it is generating you how much return? 6.5% return. So for 1 unit of risk that you are taking, how much return is being generated? Just divide by that. It will be nothing but 13 by 9. It will be how much? 1.44. That is the correct answer. So option number B is the correct one, right? So that is what Sharpe ratio tells you, that reward per unit of risk. Just remember this keyword. It tells you reward per unit of risk. See, this way we understand each and every concept. See, whenever I provide you a question, I explain you each and every part of it, right? So that you have a clear understanding of it. So better see, two things to remember here. Again I am repeating. Please remember this formula. Let me again show you the formula. Please note down the formula in your notebook or somewhere else. Please note it down. This is a super important formula. Portfolio return minus risk rate upon standard deviation. And second thing you need to remember is that higher the Sharpe ratio, base risk adjusted performance. So the question may ask you whether Sharpe ratio should be higher or lower. The answer is should be higher, right? Now friends, let's have a look at this part of the question. This is one of the most, familiar question. Every time you ask in the examination, they are asking you to calculate the convexity of the bond. So now let's see how to go about calculating this question. Now friends, think about it. What data they have given? 7 year, 7% coupon bond. They are currently trading at $105.180. Suppose bond price increased to 106.50. Okay, it has increased to this much, and yield drop by 10 basis point. And bond price decreased to this much when the yield rises by 10 basis point. So what is the convexity of the bond? Very good question it is. Right, options they have given: 210.24, 305.50, 155.65, and D none of them. Very good question. So first of all, what is the meaning of convexity? Let me show you the formula. What is the formula that we use to compute the convexity? See, let me write it down the formula here. Just wait a minute. Yes. So if we want to compute the convexity, right? So first of all, you write up P plus P minus 2 times P naught divided by P naught multiplied by delta y divided by 2, right? So this is the formula that we use to compute the convexity. Now in this case, what is P1, what is P minus, what is P naught? Let's understand. So you can see, right? So friends, please understand, very, very important thing I'm telling you, that, see, price P naught means what? P plus. What is the meaning of P plus? P plus means, price if the yield fall. Sorry. Yes, correct. Price if the yield fall. Okay, you know it very well that, price and yield are inversely proportional. I think you know it very well. Whenever yield will fall, price is bound to rise. Okay, so P plus means what? Price is rising. Okay, and when price will rise? When yield will fall. Okay, so what is the price when yield fall? It is nothing but P plus is how much? 106.50. Now what is P minus? P minus indicates, decrease in the price. No, sorry, decrement in the price. Obviously, when the yield will rise, price will decrease. And what is the decrease in the price? Okay, it decreases to 103.95. Okay, this is P minus. Okay, now you may ask me what is P naught? Yes, very good. I will answer it. So P naught is the current price. What is the current price? This is 105.180, isn't it? 105.180. That is your P naught. Okay, very good. So we know P plus, we know P minus, we know P naught. Now you have to just plug in the formula. Let me apply the formula here. And what is delta y? What is delta y? Yes, delta y is the change in the yield. And remember, this has to be written in terms of decimal. They have written, 10 basis point. Okay, so 10 basis point is what, it simply means 0.001, right? 0.001 in terms of decimal. Now plug in the number. So now we know what is our P plus, what is our P minus, what is our P naught, and what is our delta Y. Just plug in the number. So P plus will be how much? 106.50 plus P minus will be 103.95 minus 2 times P naught 105 plus 180. I request you to please solve the question on your own. And if you really think that this video is helping value to your preparation, please hit that like button. It will encourage me to make more such content. Now what is P naught here? P naught they have given 105.180. And what is delta Y they have given? Delta Y they have given 0.001 upon 2. So if you calculate it, you would get 210.24. That is your convexity, isn't it? So now if you look at the option, you can see directly that option number is the correct one, right? So other options are not matching the data, that's why they are wrong. I hope this is crystal clear right now. So friends, now the question is, how can you interpret this convexity? Now that we have calculated this convexity, what's the meaning of it? What is the physical interpretation of it? Let's have a look. You can think of the duration as the slope of the road. Suppose this is the road, right? Suppose this is the road. Okay, it has a slope. So this slope is, you can think of the duration, right? It tells you, this duration will tells you how steep price change or when the yield moves a little. You know it very well that when the yield will change, price will bound to change. And this slope tells you that what is the effect in price when the yield is changing. That is what this slope tells you. Now, if you look at the convexity, if we talk about the convexity, convexity is like the curvature of the road. Right? It is like the curvature of the road. It tells you how the slope itself changes. Yes, it tells you the rate of change of slope. Convexity tells you that rate of change of slope. See, slope tells you rate of change of price with respect to yield, and convexity tells you rate of change of slope. That's the difference, right? How the slope itself change when the yield move further. And you know it very well. Suppose there is a bond which have high convexity. Suppose there is a bond which have high convexity. What happen, when the rate fall down, bond price increase a bit more than the duration predicted. See, suppose that yield is decreasing. Duration is predicting that there will be, bond price will rise just by 0.1. But what happened in reality? Convexity predicts that it will rise by 0.2%. Right? So that is the indication that this bond has high convexity. So what I am telling you, suppose there is a bond which have a high convexity. It tells you that when the rate fall down, bond price increase a bit more as compared to the duration, what duration predict. And when the rate rise, what will happen? When the rate will rise, what will happen? That price fall extra bit less than, right, duration predict. So that extra band is very, very helpful, right? The extra band is very, very helpful. It cushion bond price when the rate swing, isn't it? So you can think of it like a trampoline. Have you seen a trampoline? High convexity versus a flat plank, low convexity. Suppose this is the flat plank, right? It has a low convexity, and trampoline with a high convexity. So the trampoline responds more smoothly and gives back more when you bounce up and down. So friends, please remember what you learned from this question. First of all, you must note down this convexity formula. This will surely help you, right? So this is the formula that we use to compute the convexity, first point. And use observed price change for a small delta Y change in the yield. And one more thing is that question may be asked whether convexity should be higher or it should be lower. Remember, convexity should be higher. Suppose our convexity increases, what does it indicate? It indicates that you have a better protection against the interest rate swing. So extra price gain when the rate fall and a smaller loss when the rate rise. That is easy in practical. Remember, duration tells you the slope, convexity tells you the bend. If you like this style, please hit that like button. I will explain each and every concept in the lucid manner, as much lucid as possible, so that you can understand in the layman terms. I hope this question is very clear to you. Now, have a look at the next one. So friends, as I told you already, 40% of the syllabus of the question paper is about the numerical. That's what we are focusing on right now. Now the question is asking you to compute the annualized yield on what? 91-day treasury bill. Face value they have given 100, currently trading at 98.80. And option they have given, these are the options, these are the 4 options. You have been asked to compute the annualized yield. Yes, very good. Again, I am telling you the formula. So I request you, please have a sheet of paper, right? A4 sheet of paper. Till now, we have discussed 3 formulas. You remember it? Please note it down. They will surely help you in the examination. Now there is the 4th formula, which I am telling you right now. So this is the formula that you need to remember to compute the annualized yield. That is what we are focusing on, right? Annualized yield of a bond. What is the formula? Face value minus purchase value upon purchase, sorry, just wait a minute. not purchase value. It's wrong. Face value minus purchase price upon purchase price multiplied by 100. Sorry. And one more thing is that, okay, since we are computing the yield, right? We are computing the yield. So what we need to do? 365 upon day to maturity multiplied by 100. Right? So this is how we go about computing the annualized yield. Right? Face value minus purchase price upon purchase price into 365 upon day to maturity to 100. Now let's plug in the number. How much face value they have given? Face value they have given 100 rupees. You can see how much present price they have given 98.80. So it will be how much? 100 minus 98.80 divided by 98.80 multiplied by 365 divided by 90 multiplied by 100. Right? So that is the point. So this gives you the discount, right? If you look at the numerator here, if you just look at the numerator, this gives you what? This gives you the discount. So it is divide the discount by the purchase price. Okay. So divided by discount by purchase price. If you compute it using calculator, it will give you how much? 0.01214. This will give you, right? And if you compute it, this will give you how much? 4.01098. multiplied by 100, and if you compute finally, this will give you 4.87%, right? If you round it off, it will be 4.87%. Now friends, let's look at the option. I think nearby is 4.89, so this will be the correct answer. Okay, so friends, this is a very important formula that you need to remember. This is called treasury bill yield. Imagine that. Let me explain what is happening here. Imagine that you buy a coupon for how much? So you buy a coupon. You have invested how much? 98.80. You have invested today. Okay, and it will be redeemed at 100 rupees in 91 days. So after 91 days period, you will redeem it at 100 rupees. Is it clear? Please try to understand what this question is asking you to compute. I am explaining it. So after 90 days, 91 days you will get 100 rupees. That is using redeeming. So basically, how much is the gain? That gain is how much? 1.20 rupees gain, isn't it? So that 1.20 rupees gain over the 91 days is your return. Right? This is what your return says. And if you want to compare it with annual return, we scale up to a year. Yes. So if you look at this particular formula, this thing is used for scaling up. Isn't it? We are scaling it up. That's why our numerator is higher and numerator is lower. That's why we are scaling it up. Isn't it? Right? And that gives you roughly the annualized return. See, this is the very simplest thing to understand. Please try to understand. I have invested 98.90. After 91 days, I am getting 100 rupees. So how much is the return we are getting? Return is I am getting in terms of rupees is 1.20. Isn't it? This 1.20 I am getting over 91 days. Right? Okay, sorry. Yes, this 1.20 I am getting over 98.90 purchase price. Right? And just we have to scale it up. How to scale it up? Very simple. You just write the 365 in the numerator divided by 90 in the denominator. And by 100%. This will give you the yield. This is one of the most favorite question that IIBF asks every year. Right? Please understand this question. Very important from a examination point of view. Now friends, let's have a look at the next question. So now we will solve a quick MCQ on delta hedging. Yes. So this concept is delta hedging. Let's understand it. So a risk manager at a bank, he has written or sold put option. He is totaling how much? I think it is 15 lakh, right? 15 lakh dollar with a delta of how much? -40%. How should the bank hedge its position using the underlying bond? That's the question. Very good question. Options are 4 options they have given you. Now friends, delta. What is the meaning of this delta? Delta tells you how much the option position changes for a small change in the underlying. Right? How much the option position change for a small change in the underlying. Let me explain. What is the formula for delta? So for the whole option position, if you compute the delta equivalent, it will be how much? It will be notional amount multiplied by delta. Let's plug in the value. How much is the delta equivalent they have given? You can see clearly they have given 15 lakh dollar. So just write 15,00,000 and multiplied by what? Multiplied by the delta amount. What is the delta value they have given? -0.40. So it will be -0.40, isn't it? So after calculate, this will give you -6 lakh. right? So this is your delta equivalent. Now this minus 6 lakh, it means the option portfolio behaves like a being short. How much? $6 lakh of the underlying, because the delta is negative. To neutralize that, when I say neutralize that, what I mean to say, to make delta 0, that is when you will neutralize it. To neutralize that, we must take an opposite position of how much? We must take an opposite position of plus $6 lakh, right, in the underlying. That means, bank should buy bond worth $6 lakh. After buying, what will happen? This will get neutralized and finally our delta will be 0, right? If you look at the option that we have, so option A is saying sell bond worth 6 lakh. Correct? Incorrect. Yes, this is the correct one, right? See, combined with the $6 lakh from the written put, the net is 0. So a small move in the bond price won't cause a first order profit or loss, right? So you can think of this put position, let me explain. So this is the kind of put position. So you can think of a put position as owing someone $600, right? As owing someone $600 every time a price rises slightly, which means you lose when the price rises. To stop losing, you take the opposite side. You buy something that gains $600 when the price rises. That cancels the loss. So if you are owing $600, buy plus 600 worth of thing, simple offsetting. So just remember in one word, if I want to summarize this, all these things, whatever I have talked just now, just remember this key point. Please remember it. So whenever you see this word, delta hedge, right? So delta hedge, you take the opposite. You take the opposite position equal to how much? Notional multiplied by delta. You take the opposite position. If the result is negative, suppose the result is negative, buy that amount. See, if the result is negative, you buy that amount. Or if the result is positive, right, you sell that. Summarize this delta hedging in just 1 minute. Compute the delta equivalent and take the opposite position. That's it, right? That is how you can compute it. And if you, I hope this is crystal clear right now. Now, friends, let's see the next question that we have. Yes, high kurtosis. Very good question it is. So the question is asking basically kurtosis, which is a concept in statistics that help us understand the shape of return distribution in finance. So the question is, which of the following best characterize, right, basically a probability distribution for a portfolio return that exhibit high kurtosis? Options are, the distributions has a flattened center with a very short tail, indicating low frequency of extreme value. Option B says that it features a prominent central peak around the average and exhibit higher chance of outlier return due to heavy tails. Option C, the distribution is uniform with no pronounced peak or tails. And option D, there is a broad spread in the middle and extremely thin tails, meaning very few extreme gain or losses. These are the options that we have, right? So friends, let's understand. Let's see first of all, let's understand the meaning of high kurtosis. So whenever I say that kurtosis is high, it means the distribution is very peaked at the center, right? Distribution is peaked at the center. Please remember it, right? So that is the meaning of high kurtosis. Distribution is peaked at the center, right? Which means most value are close to the average. Like if you draw the normal distribution curve, it looks something like this. It's all maximum values are near the normal. This is the average. Okay, but it has also a fat and heavy tail. It will also have a fat and heavy tail, right? Which means that more chance of extreme events like big gain or big loss. That is called high kurtosis. So whenever I say this high kurtosis, it means two things. Please understand it. It means that it is peaked at the center, which means most value are close to this average. It also means that it has a fat or heavy tails, which means that more chance of extreme event. So in finance, if a portfolio has a high kurtosis, you might usually see a stable return. Yes, in the context of finance, what you will see the stable return. But sometimes, sometimes very big surprises, either very good or very bad, right? Think of it like this. Most of the time, you are driving on a smooth road at average speed, but occasionally you hit a huge pothole or a speed bump that shake everything. That is a fat tail. That is called, fat tail. You hit a pothole or you hit a speed bump that shakes everything. So that is a fat tail. It is quite rare but extreme outcomes, right? Now let's look at the options that we have. Option is that flattened center with very short tail. That's completely wrong. Why? Because that is actually low kurtosis. It indicates what? It indicates low kurtosis. right? It means everything is more spread out in the middle and extreme events are very rare, opposite of what we want right now. What about option B? Yes, it is the correct one. You can see now, prominent central peak around the average and higher chance of outlier return. Yes, very good. This is the correct one. What about C? C says that distribution is uniform. See, that is when outcomes are equally likely, right? Like a rolling of fair dice, no peak, no fat tail, definitely not kurtosis. What about D? It says that there is a broad spread in the middle and extreme thin tail. Again, this means very few extreme, that is low or normal kurtosis, not too high. So friends, please remember what we learned from this question is that whenever you see high kurtosis, two things must keep into your mind. See, if I say high kurtosis, it means tall peaks. Let me write it down. It means tall peaks plus tall. It will be very taller, right? Very taller plus fat tail. Just remember these two words, right? And more chance of outlier, more chance of extreme event. And this is important for portfolio risk analysis because extreme loss are more likely. So high kurtosis means high chance of extremes, even if average low. Now friends, let's see this particular question. It is asking you, a portfolio manager, he decides to invest in a long-term bond despite current low yield, right? A portfolio manager, he decides to invest in a long-term bond despite current low yield. Apart from anticipating a further decrease in the interest rate, what is another strong reason for such a strategy, right? So very good question. Options are maximizing short-term profit, meeting future liability commitment, increasing trading volume. D says gaining media attention. See, what do you think is correct? So let me explain. See, what happened? Many institutions like banks, right? Many institutions like banks and insurance companies, pension fund, they know that they have to pay a large sum in the future. For example, pension payment, insurance claim, or maturing deposit. So buying long-term bond that mature around the same time as those payment means the institution will have the money exactly what is needed, right? When needed. See, I think you know it very well that these kinds of institutions like pension fund, mutual insurance and banks, they know it very well that they have to pay a large sum in the future. They are familiar with this thing, right? What? To pay large sum in future. Now you think about it. How do we get this large sum? So what they do, they invest in a bond which have a longer maturity and maturity around the same time as those payment means, right? It means that institution will have a money exactly when required. So this practice is called ALM, asset liability management, right? Matching the timing and size of the asset to the future liability to reduce the risk. Obviously, through this ALM, what they are doing, they are reducing the risk, right? I hope it is clear because they have a future liability of paying the depositors, and then to meet that future liability, what they require what some kinds of investments in the bonds, right? Even if yield are low today, matching future cash need is often more important than chasing a small star return. Imagine that you must pay your child college fee in the 10-year. You buy a 10-year safe bond now so that you are sure that money will be there at the right time. You are not trying to make quick money. You are securing a future payment. That is what you are doing. Now let's look at the option. So the question is why? Why this is one of the strong strategy? Option A, maximizing short-term profit. See, this is wrong because long-term bonds are held for medium or long horizon, not for short-term gain. Buying long bond when yield are low is usually not a play for quick profit. Option B, meeting future liability commitment. Yes, that's the correct one, right? Now option C, increasing the trading volume. See, this is wrong. Why? Institutional strategies like ALM, they focus on holding and matching cash flow, not boosting the trading activity. Increasing volume is not a meaningful reason to buy long bond for liability matching. What about the gaining media attention? This is also incorrect because this is wrong and this is irrelevant. Portfolio decisions should be driven by risk management and the cash flow need, not publicity. Media attention is not a legitimate investment rationale. So the correct answer to this question is option number B. Please remember, the primary reason is matching the future liability. This is the primary reason. Matching the future liability, that is our ALM. This ensures that funds are available when the payment fulfilled due. Long bond can provide predictable cash flow at the right time even if current yield are low. And this is not for short-term profit. Trading, not for trading volume or publicity. Please remember it. So one line you can remember it. If you pay money later, buy an asset that pay when you must pay. Right? That is an ALM. I hope this is crystal clear right now. Friends, I'm just wrapping up this session right now. If you want me to see, we have 100 questions available, and this PDF is available in our course. Course name is CTP course, which includes unit-wise theory, unit-wise MCQs, previous year question, as well as the capsule content. If you want to grab this, please WhatsApp me on this particular number, or in the description section of the video, you will get the link to access the course. So if you want me to bring the part 2 lecture of it and explain like I'm explaining right now, please just write yes in the chat box, in the comment section. Right, I will bring the part 2 also. I hope this video was useful for you. Please hit the like button, share with other CTP aspirants, and subscribe the channel. We will surely meet in the upcoming session. Thank you.